G'day folks, welcome back to another update on the world stock markets. Now they've all edged higher slightly since our last update. Before you go any further, make sure you hit that like and subscribe button to support the channel. Now in terms of the outlook as of today, July 3rd, the S&P gains driven by strong tech earnings, cooling inflation and Fed rate cut signals. Resilient consumer demand supports outlook. NASDAQ continues upward on AI and semiconductor strength. NVIDIA, Microsoft lead performance. German DAX stabilising as Eurozone inflation slows. ECB hint at further easing, though weak Chinese demand still weighs on exports. Japanese NIKKEI pull back from highs amid yen volatility and Bank of Japan policy uncertainty. Corporate earnings remain robust. The ASX200 modestly positive as mining stocks rebound on higher iron ore prices. RBA remains cautious on rates. And China 500 struggles persist amid weak consumer confidence, muted stimulus, and property sector remains a drag. So I'll start off with the S&P. Now we always look at the long-term trends first, and the first thing we look at is the trends on the price, as well as the CCI where it's trending along the moving averages. So you can see there, nice big bull run on the price, although notice on the CCI, if I zoom out a bit, we've got this bearish divergence, lower highs versus higher highs in the price. Now that's a very long-term play. At the moment, that's still rising since our last video. I'm going to stretch that slightly higher, and that's still declining on the CCI. So I've drawn a target area for that, and that target area is basically the 23-38% range. And again, for those new to the channel, I'll take it from the current high, and that's assuming it starts pulling back from where it is at the moment, and I'll take it back to that level. You can see there it's slightly off, but that's basically the 23-38% Fibonacci range, and that's a minimum. We expect it to pull back. So we'll keep an eye on that, but again, that's a long-term play. At the moment, the price still seems to be rising. The CCI is also rising, but it's still trending lower to where it was previously. Also notice here we've got these in this red rectangle. We've got these fair value gaps, and they're basically unfilled orders, which means the subsequent candles or wicks haven't penetrated that area. So if it does break into that 23-38% range, assuming it pulls back now, we expect it to go down to that area as well and fill those unfilled orders. We had another bearish divergence back here. You can see they hit that target and it bounced out of it. So that's a minimum retrace. Also, if I zoom in, you'll notice there we've got a fair value gap at the moment. I'll just highlight it. And that also hasn't been penetrated. So at some point, and again, this could take days or even weeks or even hours, it depends on how strong the market reacts. It could actually start pulling back to the downside. And if it breaks below that, then the next level will be this 23-38% Fibonacci range. So that's a thing we look at. The first thing we look at is the trend on the moving averages, and then we look at any divergence, and then we look at any fair value gaps. So they're the three main things we look at here. On the weekly, if I zoom out, first of all, you can see there we've got a similar declining CCI, even though it's made slight moves to the upside in the last couple of days or weeks. Still declining CCI versus the same period, higher highs on the price. And again, that price is still rising. So a bit too early to draw a target, but again, I'm just demonstrating the bearish divergence so far. If that CCI keeps rising higher than that point there, then we're going to invalidate the divergence. Also note we've got a fair value gap there that hasn't been filled. Those there have been filled previously with this candle action. So that one there hasn't been filled yet. So the weekly is also bullish at the moment. And again, the way you trade is you trade on the lower time frame in the direction of the higher time frame. So if you're trading on the daily, you can trade in the direction of the weekly. And then lastly, on the daily trends, the CCI and the price are broken above the moving averages, still bullish. If I zoom out, in fact, there is a slight bearish divergence. So if I draw from that high to that current point, it's almost a double top on the CCI versus the same period. You can see that price has broken through that previous resistance. So higher highs on the price, and that's probably a double top on the CCI there. Again, if that goes a lot higher than where it is at the moment and higher than that point, we're going to invalidate the divergence. So the daily is bullish at the moment, which means if you want to trade on the lower time frame, like the 1 hour, you take long trades on the 1 hour. So if we go to the 1 hour intraday time period, again, the next thing we look at here as well is any bullish move. And the way I prefer to trade is when the CCI and the price break above the moving averages. And ideally, you want to get into the trade when it's a fresh breakout. So you would have got in on that candle. It may be a bit, actually this is a fresh breakout as well at the moment. But ideally, you want to get when it's a fresh breakout on the price in the CCI, roughly on that one there. This one's also just a fresh breakout as well currently as we speak. So long positions at the moment. Now again, zooming out, we look for any divergence, and you can see there if I extended that trend line, and if I extended that trend line, that's also a bearish divergence. And on this one, it's again a bit too early to draw, but that'll be somewhere around this area where that resistance was previously, I'd suggest. I'll draw it anyway just to demonstrate. You can see there it's smack in the middle of that previous resistance. So it's assuming it's a 23-38% Fibonacci range. That's assuming the price pulls back from where it is at the moment. Of course, it could keep rising, in which case we have to readjust that Fibonacci retracement. And lastly, with the S&P, I'll just show you quickly the back testing. And I've started the back test here from when the price and the CCI broke above the moving averages. That was around about the, what was that, the 23rd of April. So this is a stop loss approach, and this is the average down approach. So the take profit is 3.3%, and the average down is, if the price drops by 0.5%, you take a stop loss, or you average down when the entry criteria is met again. You can see there we've averaged a few times on the average down approach, and had you let it run through the whole period, that would have generated about 20,000, almost 21,000 of income, whereas a stop loss approach is currently measuring about $172 of income. But notice what I do is with the divergence, you can look out for any bearish divergence. So you would have probably closed it out after that bearish divergence there. Another bearish divergence there, closed it out at that point, and that would have avoided that little drawdown. Started going long again when the CCI and the price broke above the moving averages. After that potential drawdown would have occurred. So again, I'm just demonstrating here the back test of the whole period, but you would have closed it out and reopened it. So long as the daily was in an uptrend. And again, going back to this point here on the daily, you would not have taken any trades. You can see there as well on the 1 hour time frame, you would have closed it out at that point there, which means you would not have had that drawdown at that point on both the stop loss approach and the average down approach. Another closeout there on the daily, again, you would have closed it out there, and you would have avoided that drawdown on the stop loss approach and the average down approach. So for the NASDAQ on the monthly, the price is also above the moving averages. It's broken through that resistance. The CCI, however, also broken into that moving average range, giving us a slight neutral to bullish movement. But notice again, if I zoom out, we've got a bearish divergence there on the CCI versus the price. So again, we expect to see a pullback. And also notice here as well, if I zoom in for a moment, we've got another fair value gap which hasn't been filled yet. And again, this could happen overnight, or it could take days or even weeks or even months to play out, depending on how strong or weak the market is becoming. But again, considering this bearish divergence, I'd say it's going to happen sooner rather than later. So don't go too heavy on trading the NASDAQ so far. So somewhat bullish movement on the NASDAQ if you're trading based on the trends. On the weekly, we've got another bearish divergence there. You can see the CCI is still dropping off. Even if you draw from that point there, there's still a declining CCI versus, I'll just draw a new trend line from that high to that high. That's still a bearish divergence. I haven't drawn a target, and I won't, because that looks like it's still edging higher. But again, you can see where if it does pull back, it'll likely pull back in this area. And also here we've got a couple of fair value gaps to be aware of. Also notice back here on the monthly, as well as that fair value gap, we've got these ones down here which haven't been penetrated yet. So just be mindful. That could be a significant decline in the market. Who knows, because of a war or some other economic factor in the world events. But that could be something that could affect us in a not too distant future. Again, it could take years to play out, or it could happen suddenly. So we're not too sure yet. We don't know how far these divergences are going to go. On the daily, again, it's edged above those resistance areas. There's also a double top on the CCI at the moment. Again, that's probably about double top almost on the CCI versus the same period going higher on the price. So it's a bearish divergence as well. And that also coincides with this fair value gap. Again, I won't draw the target range for it, but that'll be somewhere around this range of a 23-38% Fibonacci range. But if you look at the daily only, if you're trading on the 1 hour, so let's go to the 1 hour chart. So here's the, again, taking long trades only. Again, notice here we've got a bearish divergence, still declining CCI. Now that actually has gone to that point. We take it the same area on the price to that high, and that could have possibly started to decline. So let's just see if those little dips actually penetrated the 23% range. So we draw a Fibonacci, and you can see there, they just touched the 23% Fibonacci range. Okay, it doesn't mean they're going to crash right through necessarily. You can see those 2 points, those 2 wicks have penetrated that 23%. That's all you need for that divergence to take effect. So don't go placing. I don't trade this to go short, for example. I don't trade it that way. I trade this to look at it. So if I'm going long here on the 1 hour, if I'm trading that in the direction of the daily, I look at the divergence, a bearish divergence, and close out my positions. So long as I'm happy with the results, I close them out and I avoid any particular drawdown. Now, this is obviously a very light bounce off that divergence. Sometimes they actually break a lot lower and actually go beyond 100% retrace. So you can't really tell how far they're going to go. Now, if we look at the back test on the 1 hour time frame, similar to the S&P, started back here around about the 23rd of April this year. Stop loss approach is below our baseline of 100,000, so we're losing about $800 odd on that one. Whereas the average down, because of it averaged down quite a few times, it's up about $8,500. Now again, notice we've had a few bearish divergences here, and that's where you would have closed out your positions after seeing those bearish divergences and then re-enter them once the CCI and the price started moving in alignment. So you would have avoided that one there, you would have avoided that drawdown as well. There's another little bearish divergence there. You had a little drawdown there. And currently we've got this bearish divergence, as I said, on the 1 hour. So just be careful about going long too strongly. We might see this break further to the downside on the price. So looking at the German DAX, that's also bullish above the price on the monthly and also bullish on the CCI. And there's no divergence that I can see. However, notice, oops, let's move that back down there. Notice here we've got a couple of fair value gaps. This one down here was penetrated by the wicks of those 2 candles. And likewise, these fair value gaps were also penetrated by that long wick there. Now this one up here as well in the very short term, that still hasn't been penetrated, so we'll mark that. So just keep an eye on that. But at the moment, I'm still bullish on the monthly, but do note we've got a couple of months so far of slightly bearish movement at the moment. On the weekly, again, zooming out first off, the CCI has broken into that moving average range, even though the price is above the moving averages. And note, we do have a bearish divergence. Now, if you notice a pattern amongst these indices so far across the world markets, there's a longer term bearish divergence, which means we may have a bit of a pullback or a correction, hopefully not a recession, but at least a correction. This is a bit worrying when you've got these fair value gaps down here, which means it'll be more of a recession type of event, possibly, if they play out in the near term. So again, just be aware of those. At the moment, it's having trouble breaking through that resistance on the weekly. On the daily, first look at the trend. It's somewhat bearish to neutral on the CCI. Still bullish on the daily, but notice the moving averages are trending down, which is not a good sign. You want to see the price above the moving averages when the moving averages are trending up, like in this period back here. And notice as well, we've got a short-term fair value gap there. That one's been filled with those actions of those candles. These 2 down here haven't been filled yet on the daily. So again, we may see a pullback. And if I was to draw a Fibonacci on this one, in fact, that's already been drawn, the target. That's at 23-38% range we identified previously. So again, that looks like it's just touched that. You can see those candles there have penetrated that range. So that divergence may have already played out. But again, just be mindful, at the moment that those moving averages are trending down, which is not very helpful. On the intraday, again, we look at the micro charts. So if you're trading on the 1 hour, or even if you're not, if you're trading on the daily, we still look at the micro charts. And the 1 hour is a good example. Here we've got a bearish divergence versus high highs in the price, and I've drawn a 23-38% target range for that. And just to demonstrate again with the Fibonacci, that's at 23-38% Fibonacci range. We had a back here we had a bullish divergence, and there's that 23.38%, and it broke right through that, and this one's also broken through on the downside. So at the moment, avoid going long until we see that daily break higher on the CCI as well. The hourly is already bullish, but again, I'd like to see that break above on the daily to be more bullish. But especially I want to see a break through this resistance to be more positive about the DAX. Now, if we go to the back testing, here we've got the stop loss approach and the average down approach. And again, I've taken it back to about the 23rd of April, similar to the S&P and the NASDAQ. And again, you would have closed it out at the very latest when the daily CCI broke into the moving average range. But even in between the hourly trades, you would have noticed the declining or the bearish divergence, like in this period. And I've highlighted those movements there. And more recently to this point, at that point there, you'll notice here, it broke down below the moving average on the daily, which means you should have closed out all positions at that point, and you would have closed out near the high there. The stop loss approach was generating about $3,100, and the average down was about 20,300, and that would have avoided that drawdown on both the stop loss and the average down approach. Now, since then, we had a bullish divergence on that point, and you probably would have started going long again since our last video around this point there. So for the Japanese Nikkei, on the monthly, it's bullish above the moving averages, but note the CCI is trending on a downward trajectory. So they're not a positive sign. I'd like to see that break above the moving averages to be more positive on the monthly. Also notice down there, we've got a fair value gap, and I'll highlight that as well for future reference. And we've got another major one down here. Now this one's been penetrated about 25% of that range. So we may possibly see the price decline further if all the other markets are showing the same sort of pullback. We've got this one back here has been penetrated about 75%, and back here that hasn't been penetrated at all. So very long term, not looking too strong for the world markets if this is any indication, if all of them are showing fair value gaps below, very, very much below where they are at the moment. At the moment, neutral to slightly bullish movement on the monthly. On the weekly, bullish movement with the CCI and the price above the moving averages, but again, notice that declining moving average range. And again, here we've got the fair value gaps haven't been penetrated. And also back here, we had a bearish divergence, and it filled that 23.38% very easily, twice actually, once there and again there. And we had a double bottom off that support line. On the daily, again, it's broken through that resistance, and there's no divergence to talk of. That high has gone beyond those previous highs, so there's no divergence. And here we've got these fair value gaps. Now, on the positive side, there's these two fair value gaps up there, haven't been penetrated yet. And this one down here is about halfway done. So then we've got another one down here that hasn't been touched yet. So these ones down here on the daily haven't been filled yet. This one is mostly filled, but this one down here hasn't. Very narrow one, but again, not looking 100% positive, but again, we only go with the direction of the trends. So at the moment, if that daily breaks higher on the moving averages on the CCI, we take long trades on the intraday chart. And on the 1 hour chart, again, we look for any divergence. At the moment, you'll notice, again, wait for that daily to break higher. And as soon as that happens also on the hourly chart, you can take long trades. Back here, we had a bearish divergence, and that extended from our last video, that extended further to the upside, and that would have remained there. So if we remain that, pull it back to that level, you can see there in terms of Fibonacci retrace, that pulled back to about the 50% level, but it penetrated our 23.38% very easily. And now it looks like it's starting to correct itself and move further to the upside, possibly. But again, I'd like to see that daily break higher. On the back test on the stop loss, that's about break even at the moment. And on the average down, it's about 66,000. Now, again, there's quite a few drawdowns there, multiple contracts entered. So remember, you close it out at the very latest when that daily CCI breaks into the moving average range. But even if that doesn't happen, you still follow any bearish divergence on the hourly. You can see there's been a couple of bearish divergences there. I've marked them. There was a bullish divergence there after it dropped off. and that one dropped there. You can see that bearish divergence dropped down to about the 23-38% range. Then it bounced, had another smaller bearish divergence there. It dropped off again. Again, you would have avoided these drawdowns. And more recently, you had another bearish divergence there. And lastly, where we are at the moment, as I've indicated on the previous chart, we've got a bearish divergence currently in play, and that's already broken down. So you would have closed it out during those periods if you hadn't already. So for the Aussie market, the ASX, first of all, the price and the CCI are above the moving averages, so bullish momentum. However, we've got a bearish divergence still in play. It's actually broken down, hit our 23-38% target range there, and it's bounced out of it, so that could have already completed, in which case I'd like to see that CCI break a lot higher and to help to start moving in line with the price. But potentially that could still be a bearish divergence, because that could just a matter of extending that and extending that trend line as well. So just be cautious, and plus you'll notice here we've got a fair value gap that hasn't been penetrated yet on the monthly. So just be aware of that. This one back here was penetrated with the wick of that candle, and those there were also penetrated. On the weekly, bearish divergence again, higher highs on the price, and I've drawn a target range there. As soon as if that goes any higher, I'll just readjust that target. Also notice here we've got a fair value gap, hasn't been penetrated yet. So again, cautiously bullish on the weekly. On the daily, likewise bullish with the price and the CCI moving averages. Let's zoom out. There is a double top there on the price versus lower highs on the CCI. That's a bearish divergence. And if I was to draw a target on that, I'd take it back to what you normally do is you take it back to the significant low before the divergence started. And we could probably put it there for the moment, but I'd like to see it go there because we've already had quite a decline there around that was around April this year. So if we drew it to that level, you can see at very minimum we want it to touch, well not want it, but we expect it to touch that range there, which is the 23-38% range. It's about there. So that's on the daily. So at the moment, cautiously bullish. I'd like to see it break through that resistance, and I'd like to see the CCI break higher as well to be more confident. So just be cautious about going too heavy on the ASX if you're trading that. So bullish movement on the daily, and on the intraday, we look at the 1 hour charts for any funny moments or any funny movements. We had a bearish divergence back there, and you can see there the price has been moving in tangent with the CCI, except for this area here. So what you do is look for the peaks. There's a bearish movement there versus a slightly higher highs on the price. That's a bearish divergence. Now, to draw a target Fibonacci range for that, you take it from that high to that low. You can see there it's broken right down to the 60%. That's already hit that 23-38% range on the 1 hour time frame. And that was a very sudden move. It happened within a couple of hours. But also notice we had this, when that bearish candle occurred, we had this fair value gap, that pink area, and that's already been penetrated mostly with the last couple of hours. These fair value gaps have all been filled with the subsequent candles. If we go back to the back test, stop loss approach is up about $1,100 since around the 23rd of April. But again, you would have closed it out at, if you're following the daily, when the CCI broke into that moving average range. And again there, when it closed off and the price started to weaken, you would have closed it off at those periods. But even if you didn't, you always pay attention to the 1 hour charts. You can see there's bearish divergence throughout the whole period littering that movement. Up until this point, you'll notice here a bearish divergence, and that's where we had that major drawdown. You would have avoided that at that point there. You'll notice that was at the end of that bearish divergence on the daily as well, just coincidentally. And that's where it turned negative, and you would have closed out your position. If you're trading both the stop loss approach and the average down, you would have closed them out at that point there on those respective trades. So the Chinese market's not doing too badly, but it's broken above the moving averages on the monthly and also on the CCI. Now, even though it's done that, you notice it was still in a bit of a decline longer term. But just be cautious. We've already filled that fair value gap there. There's no divergence that I can see on the monthly. On the weekly, we had this, if I zoom out, we had this bullish divergence back here versus lower lows on the price. And that broke up into our 23-38% range. if we drew a Fibonacci between that area and that high up there. Now since then, on the weekly, it's still bullish, both the price and the CCI above the moving averages, so bullish momentum. There was a fair value gap here, that's filled about 75% of that range up until that support level. It could drop a lot further, but at the moment it's bullish momentum on the weekly. On the daily, now it's been stuck in that range, as I said. Fresh breakout to the upside on the CCI and the price, so bullish momentum or bullish trades to be taken on the 1 hour time frame. And there's those fair value gaps down here. That hasn't been fully filled yet with that candle, that wick bouncing off that support. And there's no divergence that I can see at the moment. Yep, that's all in sync with the price. So if we go to the 1 hour chart, we'll find any micro moves, even if you're trading on the daily. We see if there's any action happening on the smaller time frame. And the 1 hour is a good time frame to check for any divergence. So the first thing we look at if you're trading on the 1 hour is the price and the CCI above the moving averages. That's a bullish move, which you can take long trades. And next thing we look at is any divergence. The last divergence we had was back here, a bearish divergence, and that broke down and hit down to about 61% of our Fibonacci range, of that range there. And also notice it's already penetrated that fair value gap. This one down here, the fair value gap, has been penetrated about 25% of that range, but it could have further downside to go. And next we look at the back testing on the long positioning. That's about break even at the moment on the stop loss. And the average down had a massive drawdown here, and you would have avoided that had you got out of the trade based on the daily. You can see there the CCI broke into that moving average range, and you would have got out somewhere there at the very latest had you followed that logic. Probably got into a long trade there, but again, that would have been very short-lived because then it broke down into that moving average range very quickly, so probably a small loss to be taken. And then since then, you would have avoided going long with that CCI below the moving averages. So you would have avoided that drawdown. That one, you would not have gone long there because the price is still below the moving average. The next long position would have been at that point there, which is about this area here. You would have gone long, and you, again, following the logic, you would have paid attention to that bearish divergence where the price broke down, as I've already spoken about. Also, I want to demonstrate the back testing for the short positioning. So I've got here the back testing starting there for around about the 28th of May. So when the price and the CCI break below the moving averages, the stop loss approaches down about $700-800, or sorry, no, about $300. And the average down is up, but again, you would have avoided this drawdown because you would have noticed this bullish divergence on the 1 hour. So you would have closed out your position at that point. So that would have been probably a break even. Avoid going short during that period. And then wait until you got another short entry. So somewhere in that area around there, you would have taken more short positions here. And then again, you would have avoided going or closing out your positions once you see the moving average band turn up and the price break above that. So you would have closed it out somewhere there and avoided going short again. Now, since then, the price and the CCI haven't broken below on the daily, so you would have avoided taking any further short trades currently. So if you're new to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. And if you enjoy the content, subscribe at least on the free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.